Hello, Simon Peters, Investment Strategist at Algebris. I was asked yesterday by a client, is it safe to go back into bank equities? And I thought I would share my views with you today. I want to start off talking a little bit about where we are in the economy, the fact that it's becoming increasingly clear that bad debts for the bank sector are a P&L event, not a capital event, a more problematic capital event. The fact that regulators are now supporting the bank sector and encouraging them in M&A, and equally where we are in terms of bank share prices and the prospects for 2021. So straight on with that, the economy. Well, it's continuing to recover and we expect further strength with vaccine rollout and fiscal support in 2021. The economies are continuing to recover from the government lockdowns, vaccine rollout and the additional fiscal support from, for example, the EU Recovery Fund, which is 750 billion euros, and that starts at the beginning of 2021. That will provide further economic stimulus. Clearly, we've had the stimulus, both monetary and fiscal side, which has allowed markets to price in a recovery, but not actually for bank shareholders yet. Government guaranteed loans, grants for those schemes supporting both households and companies have significantly reduced bad debts and tail risks for the bank sector. And it's becoming increasingly clear that bad debts are a P&L event for the banks, not a capital or share count problem. Now, it was understandable in March as we saw the largest GDP contraction in over a century. There was considerable uncertainty on likely provisions. And the last time, of course, this happened was in the global financial crisis, where all banks raised equity. Now, banks have absorbed large provision charges in Q1 and Q2 of this year, and most have remained profitable, with capital ratios entering this crisis the highest ever, and we're seeing these capital ratios going up, not down. So the feared equity raises are not happening, and now the economy is also recovering. We expect provisions to start normalising more in 2021, leading to a profits recovery. So perhaps the biggest conclusion from the bank's fundamentals this year is that the banks are finally fit for purpose. The shadows of the global financial crisis should start to dissipate, and hopefully that will reduce the very high cost of equity as well. Now, interesting to see how the regulators acted, because obviously over the last 10 years, the banks have really been increasing their buffers, capital liquidity significantly, so that in any economic downturn, they won't be as affected as they were negatively in the global financial crisis, and that's clearly been borne out. But the regulators did panic a bit, understandably so, I would say, and they stopped banks paying dividends in March of this year. Well, last week, the PRA, and the day before yesterday, the ECB did something similar. They allowed the cautious resumption of dividends. And despite, say, the ECB earlier this year not cutting interest rates like the Fed did, the ECB did start to offset some of the negative side effects of negative interest rates to the banks. So over the summer, for example, through TLTROs, the ECB is actually paying money to the banks, and the ECB just increased that this week as well. Now, the SSM, which is the ECB's bank supervisory arm, has clearly signalled its desire for banks to merge and cut costs, basically to improve profits. And as a result, we've already seen this year the largest M&A wave to occur for more than a decade in European banks. Large premiums and improved profitability are definitely two positive catalysts for equity investors. So where are we in terms of bank share prices? Well, we are currently at March 2009 lows. So banks are currently at their March 2009 lows, despite not needing to raise capital, and with the economy already 9 months through its recovery. Now, a lot of banks would need to rally 50 to 100% just to be where they were at the beginning of this year in share price terms. Well, with profits likely to recover throughout 2021, we don't think that's a particularly unrealistic prospect over the coming 6 to 12 months. Now, bank credit has actually already recovered back to their pre-COVID levels, and we would expect bank equity to follow that over the next year. Now, price to tangible book values are broadly at 0.57. They bottomed at 0.6 in the March 2009 crisis. You've got recovered P's of sub 4 times, and prospective dividend yields of 7% in 2022 as they start repaying or starting to pay dividends again. We would expect that to start being priced throughout 2021, especially the latter half of 2021. So just with the passage of time and the increasing confidence that we are seeing a renormalization in the economy. So with that, the conclusion is, yes, for a decent catch-up play, the bank sector is probably worth a look. If you'd like to talk about this more, please get in touch. And until next time, thank you.